So the reason why I am doing this is to be able to benefit a lot of people out there who are looking for financial security, confidence, and their ability to make money without sacrificing their time from their family, children. I benefited a lot from this, and it's giving me a lot of confidence in my ability to live this life without, getting stuck into the employment world and giving me a peace of mind that I'm going to retire and I don't have any more future anxiety about money. Coming from a very, very, very hard childhood. I'm really happy to be doing this for anyone who's interested and found my channel.
The content in this video is for educational and informational purposes only. I'm not a financial advisor. The ideas expressed in this video are my personal opinions and experiences and not my financial recommendations.
So let's jump right into it. Options. What are options? Options are contracts, and they're giving you the right, but not the obligation to buy or sell an asset at a specific price, specific time frame. This specific price that you trade the option is called the strike price, and the time frame is the deadline that you have that right but not the obligation to buy or sell asset. If you're buying an option, you are paying a premium for the right to buy the asset. And if you are selling the option, it means you're receiving the premium that option buyer is giving you. So one option always represents 100 shares of an underlying stock. So if you have one Apple option that you buy, it means 100 shares of Apple. And it moves in correlation with the Greeks of that option. We'll get to those later. So there are two kinds of options. One is calls, the other is puts. You can buy each of them or sell each of them depending on your strategy, if you're bullish or bearish. The call option, I have to call it a reservation because when you're buying the call option, you're reserving to buy the stock at a specific price before the expiration date. You are basically, with this strategy, when you're buying a call option, you are hoping that the stock price is going to go above your strike price, and that's how you're going to make money. If you're selling a call option, you are bearish or you think the market is going to stay flat, you collect the premium. The option buyer is giving you the money, you're selling it to them, and you're thinking that the stock price is not going to move above the strike price that you're selling the call option, but you are obligated to sell your stocks if the option buyer calls it away because he has the right to buy the stock. So let's give an example how this works. Let's say there's a gaming store and they are preparing to launch this gaming console. And everyone thinks it will cost $500 next month when it launch. And then you are buying a ticket, basically, to be able to buy this console $500 if it's $1,000. So you're hoping the price is going to go up, the price is going to be above that $500. You're paying $20 for the ticket. Let's say if it's not $500, it came out at $400, you lose $20. So you're basically risking a premium. You're paying a premium to buy the console at a specific price when you think it's going to be up. But if it's below that, you're losing your money and that ticket is useless. So a lot of like institutions buy puts to, or anyone who has a portfolio and then you think like recession is coming, oh my god, the stock market is going to crash, I gotta do something on the side to be able to make money while all my stocks are down, and I don't want to wait for like a year or two to for it to come back. I need the money. And you buy a put option and you are hoping or thinking that the stock price at Apple $100 is going to go down to $50 and you're going to make money because you will have the right to sell that stock at the stock price that you are paying premium for. And if you're selling a put option, you're thinking the stock price is going to stay flat or is going to go up. It's more like a bullish move, and you collect the premium and you are obligated to buy the stock if the stock price goes down below the strike price that you sell the put. Let's say you bought a used car for $10,000, but you're worrying something is going to happen with this car and I'm going to lose my $10,000 worth of investment. So you are working with an insurance company and you're paying them $500 for a protection plan. And this plan says if the market for the, let's say, the value of your car goes down, you can sell it to us and we're going to give you $10,000 regardless of the price of that car at the time when you want to sell. So the time comes, the price crashes, your $10,000 car is now $4,000. So instead of worrying, oh my God, I lost $6,000, go to the insurance company, you're saying, hey, look, I got this plan. I am ready to sell my car and I want to get $10,000, but it is now $4,000. And they have to do it and you are protected. But if the price stays high, it's still $10,000 a year later. Now, your $500 you paid for is now trash, but you had a peace of mind. So a put basically is a bet that the stock price or an insurance, some people like to do it, stock price will go down and you want to protect what you already own. But stock market, it's more bullish than bearish. So there are a lot of risk in buying the puts. I am more conservative. I like to preserve my money. So I'm more on the seller side. There are ways that I buy the call option. I will get to it. And there has to be certain criteria that needs to meet to exercise that strategy. So, selling option. This is my secret sauce. I love it. I love it. This is where I make consistent money. So, instead of buying the tickets or the insurance and hoping it's going to go up or down, I'm going to make money that way. I become the store, I become the car insurance company. And I collect, you pay me the car insurance premiums. So selling cash secret put, you are the discount shopper at the stock market. So you are basically getting paid to wait to buy a stock, your favorite stock, at a discount. So imagine there's a stock you really like. Let's say Nvidia. Nvidia is right now at, let's say, $100. And you think it's, oh my God, so expensive. It's all-time high. I can't pay for this. But I would like to buy it if it's down $90, 10% down. Wow, what a discount. And you tell the stock market, you say, I promise to buy this stock for $90 if it ever dropped that low. And then the market says, option buyer says, okay, cool. Thanks for taking that risk. Here's $200 in cash I'm giving you just for making that promise and waiting to, to own the stock at $90. If the stock price go down to $90 or below, when you sell a put, you own the stock. So that's the risk. I feel like you don't really lose. You will get to own a stock that you really like and you think it's going to be like, I don't know, $200 in 5 years. And you got it at a 10% discount and you still get paid $200 for that. But if the stock goes up and stays above $90, you are, you get to keep the $200 and next month you sell it again, sell the put again, and you receive a premium again and you wait for the stock to drop to $90 to be able to own it. So selling a covered call, this is like a rent collector. You have an asset that you own, 100 shares of NVIDIA, let's say, and you are like, I want to make money off of it while waiting the stock goes up because it's just sitting there. And then you're telling them, I'll give you a ticket to buy my shares from me for, let's say, $110 anytime this month. You are, so they're paying you a premium. You're collecting the rent, the premium. If the stock goes up to $150, you're gonna sell it them. You are obligated to sell it them if the stock's at $150. So not only you get that capital gain, but also you get to keep that premium if the stock is above $150 strike price. But if the stock stays flat or below your strike price, you will keep the premium. You got a dividend, you got a rent, and you get to do that next month while you're waiting for the stock to appreciate. So, okay, let's summarize it. Buying a call option is a reservation. You think the stock will move, and you're gonna make money from it. If you're buying a put, you are insuring your portfolio. The stock will crash. You're gonna make money. You're insuring your capital. If you're selling a put, you are a car insurance company getting paid a premium. But if the car crashes, you have to own that car. From my experience, 90% of the time, I don't get SI on the stock, so I always keep the premium. But be prepared to do that. And I don't ever sell puts on the stocks that I don't want to own. And if you're selling a call option, this is like a collecting rents, or if you want to talk from stock market term, it's like a collecting dividend while you're waiting for the stock price to appreciate. And if it goes up, you get the capital gain, plus you collect the premium and you sell it. It's very important not to get attached to the stock at that point. But if you get called away from your stocks, you can sell it, put again, and get a side. So remember always the risk is the 100x rule. Because you're buying or selling one call option or put option that represent 100 shares of a stock. So it always controls that 100 shares. Your portfolio could have like a lot of like swings, because if the stocks move $1, your 100 share contract value is going to swing that much too. So it's very important to understand and size it according to your portfolio. So if you want to learn how to trade simply, safely, make sure to subscribe, like this video, and I'll see you in the next one.